There are 220,000 fewer homes in Australia than we actually need right now. And as rental listings plummet to record lows and prices hit new highs, something remarkable is happening this December. Buyers are scrambling into the market before the year ends. This is the moment you've been waiting for, or are you about to overpay? Today, we're breaking down exactly what's changed in the Australian property market this week and what it means for your investment strategy going into 2026. We'll show you the three critical numbers the RBA just released that are keeping rates locked at 3.6%, why December is called the property dash, when most markets usually sleep through the holidays, and the brand new government scheme that just launched on December 5th that could change the game for first home buyers, but only if you understand the hidden conditions. Welcome back to your weekly Australian property market updates. I'm your host, and every week we dig into the data, cross-check the facts, and cut through the noise so you know exactly what's moving the Australian property market. So this week, we're looking at a market caught between two powerful forces. One side, you've got the tightest housing shortage in Australian history, over 220,000 homes missing from the supply. On the other side, interest rates are staying firm at 3.6%. Inflation is hotter than expected, and the Reserve Bank is signaling patience. What's that result? Record activity, record prices, and record confusion about what to do next. So let's start with the most important number. National prices have just hit $966,000 for the median house. That's according to the latest data from Cotality. Correct, through the end of November 2025. In Australia's capital cities, that number jumps to $1.11 million. But here's what matters more than the headline. Prices rose 0.5% in just 1 month and 8.7% in the past 12. That's the fastest annual growth we've seen since mid-2022, and it's happening while affordability is crumbling. So let me be direct. Australia doesn't have a demand problem. We have a catastrophic supply problem. Last week, AMP Chief Economist Shane Oliver published analysis showing Australia has a cumulative shortage of somewhere between 220,000 and 300,000 homes. Not projected, not forecasted, existing right now. This shortage started accumulating in the mid-2000s when population growth jumped by 150,000 people per year due to immigration. But housing completions never matched the increase. Even when units boomed between 2015 and 2020, the shortage was only partially relieved. The pandemic slowed migration temporarily. But once borders opened, we went right back into deficit. So how bad is this shortage? Real estate listings for sale have fallen 13.8% year on year. Rental listings are down 16.2%. Now, we're sitting with roughly 100,000 fewer homes listed than on average between 2011 to 2019, despite having a significantly larger population. The rental vacancy rate is now at 1.15%. That's not just tight, that's a landlord's dream and a tenant's nightmare. Rental affordability has hit a record high of 33.4% of median household income just to cover the rent. This isn't sustainable, but it is profitable for investors, which is why investor activity is at 3-year high. Not all Australian markets are created equal right now. Perth is leading the charge with a 15.5% annual growth, followed closely by Darwin at 14.1% and Brisbane at 13.7%. Adelaide and Canberra are holding steady with solid growth. Sydney and Melbourne are moving more slowly, with Sydney seeing 5.1% annual growth and Melbourne approaching single-digit growth. This matters because it tells us something crucial. The big Australian migration is not evenly distributed. Infrastructure investment, job markets, and cost of living are pushing people towards regional capitals. Queensland has attracted 31% of investor property purchases in 2025, the highest allocation of any state. Why is that? The 2032 Olympics are coming. Infrastructure is building. Prices haven't yet caught up to the fundamentals. Let's look at the auction data from the past weekend. Sydney had 1,020 properties cleared to auction with a 66.6% clearance rate. Melbourne had 1,421 properties with the same clearance rate. Adelaide, traditionally weaker in spring, hit 75% clearance rate. Brisbane, however, was at only 45.2%, telling us that Brisbane's rapid growth has attracted enough demand that sellers can be selective. The pattern is very clear. When supply is tight, clearance rates hold firm. When prices have moved too far ahead of local fundamentals, like parts of Brisbane right now, buyers pause. Normally, December is sleepy. Sellers don't list, buyers are on holidays, and agents spend time with family. But not this year. We're witnessing what is called the December Dash. Over 2,600 homes scheduled for auction in late October alone, with more than 3,200 planned for November before Melbourne's Spring Racing Carnival pause. In any other December on record, these numbers would be shocking. Why is this happening? Well, three reasons. First, interest rates are on hold. The RBA has kept the cash rate at 3.6%. And every major bank, CommBank, NAB, ANZ, Westpac, is now predicting rates will stay there through the entirety of 2026. That certainty is valuable. Buyers know what their borrowing will cost. Second, supply is so tight that sellers know December is actually the best opportunity. Fewer listings means less competition. More buyer desperation means better negotiating power. It's counterintuitive, but it's working. Third, government incentives just launched. On December 5th, the Help to Buy scheme opened applications. This is significant. So let's break down the Help to Buy, because if you're a first home buyer or supporting someone who is, this needs to make sense. The government is offering to contribute up to 30% of the purchase price for existing homes, or up to 40% for newly built homes. In exchange, you need a minimum deposit of just 2%. That's extraordinary compared to traditional lending, which usually requires 10 to 20%. But here's the catch. There are 10,000 places per year. The eligibility is strict. Your tax income must be or at below $100,000 if you're single, or $160,000 if you're joint or a single parent. You cannot currently own property in Australia or overseas, with some exceptions, and the property must fall under strict price caps set by region. For the right person, a high-income earner who can't save a large deposit despite earning well, someone locked out of the market by deposit requirements, this is transformative. For someone at the income cap already scraping to save 5%, it might not help. But more importantly, Help to Buy adds fuel to an already constrained supply situation. It puts more demand side support into the market that doesn't have demand problems. It has supply problems. This could drive prices higher without solving affordability. The National Housing Council forecasted earlier this year that even with initiatives like Help to Buy, Australia will fall short of its 1.2 million homes target over the next 5 years by at least 262,000 dwellings. Supply remains the binding constraint. On December 5th, the RBA held rates steady at 3.6%. This was expected. What wasn't expected, however, or rather what confirms what many feared, is the inflation print. In October, headline CPI came in at 3.8%, up from 3.6% in September. The trimmed mean, which strips out volatile items, also ticked up to 3.3%. That's the highest we've seen in months, and it puts the RBA under genuine pressure. The RBA's target is between 2 and 3%. We're above that target. Inflation is sticky, particularly in the housing sector, where it costs up to 5.9% annually. That includes electricity, which is up 37.1% due to government subsidies. Rents are rising across every capital city, and new dwelling costs are rising as well. The RBA's statement made clear that they're not in a rush to cut rates. Governor Michelle Bullock told markets it's possible there are no further rate cuts. It's possible there could be some, but we might not need to come down as far. This is crucial. The market was pricing in multiple rate cuts through 2026. Those expectations have shifted dramatically. ANZ removed its May 2026 rate cut forecast entirely, now expecting rates to hold through the full year. Commonwealth expects no movement throughout 2026. However, Westpac still thinks there is 2 25 basis point cuts might come in early 2026, but the probability is lower than before. So for your mortgage, here's what this means. If you're on a variable rate, prepare for rates to stay where they are. If you're on a fixed rate coming due in 2026, understand you might not refinance at a lower rate. The cost of borrowing is locked in. While headlines focus on rate decisions and inflation, two longer-term forces are reshaping Australia's property market. First, migration. Australia had just recorded its highest ever levels of permanent and long-term arrivals. In the 12 months to September 2025, we welcomed 468,000 net migrants, the highest on record. In the first 9 months of 2025 alone, 415,000 arrivals landed. Again, the highest for any 9-month period. This migration is concentrated and strategic. Skilled workers, international students, and long-term settlers are choosing Australia because of our strong economy, high living standards, and stable political environment. New Zealand alone is losing record numbers of people to Australia. Over 72,000 Kiwis moved across the Tasman in the year to September. That demand is real. It's ongoing, and it's structural. Australia's population is growing faster than the housing supply, and that gap won't close soon. Second, investor sentiment. Despite market nervousness, the Property Investment Professionals of Australia annual survey found that nearly 6% of investors believe the next 12 months is a good time to invest in residential property, up from 45.7% in the prior year. The investment property loans accounted for 37.8% of new loan commitments in the first half of 2025. Investors see yield, they see demand, and they're re-entering the markets. This is important for renters and first home buyers. Investors drive construction through positive cash flow. Investors maintain rental properties and expand the supply. If investor confidence is rising, and it is, that supports new build activity. Quick context on the global factors reshaping Australian sentiment. The US Federal Reserve cut rates in December to 3.5 to 3.75%, marking the third consecutive cut. However, the Fed struck a more hawkish tone than markets expected, signaling fewer cuts ahead. This matters because it strengthens the relative attractiveness of the Australian dollar. In 2025, the USD and AUD exchange rate fell to 6.87%, meaning the Aussie strengthened significantly. A stronger AUD is a mixed signal. It helps Australian borrowers when refinancing or importing, but it can soften export competitiveness. For property, it means foreign investments, which is now banned for established homes as of April 2025, was already cooling. China's economy is also flagging. November data showed factory output and retail sales weaker than expected, with property prices continuing to fall across major cities. The Chinese property sector remains in its fifth consecutive year of decline. While Australia doesn't directly depend on a Chinese property boom, Australian investor confidence does track global risk appetite, and a weaker China signals caution. Let me synthesize this into what actually matters for your investment decisions. First, supply is the defining constraint. Prices are unlikely to crash because homes are scarce, but prices are also unlikely to soar another 20-30% like during COVID booms. We're in a normalized, constrained market where supply matches or exceeds our real underlying demand. Second, regional markets are outperforming the capitals. If you're not locked to a specific city, Perth, Melbourne, Brisbane, Adelaide, and Darwin offer better growth momentum than Sydney or Melbourne. Queensland in particular looks positioned for sustained growth thanks to infrastructure investment and relative affordability. Third, interest rates are pinned for now. Don't assume a 25 basis point cut is coming in early 2026. Plan conservatively. If you're refinancing or borrowing, lock in certainty rather than chase a cut that may not materialize. Fourth, rental yields are stabilizing but softening. Annual rental growth is at a 4-year low across major capitals. This isn't a disaster, it's normalization. A rental investment should be about long-term capital growth and secure income, not short-term yield compression. And fifth, new government schemes help marginal buyers, not market transformers. Help to Buy is well designed for eligible applicants, but doesn't solve Australia's supply deficit. Keep that in perspective. If you found this breakthrough useful, please like the video. It helps us get these weekly updates in front of more Australians who are serious about their property future. Leave a comment if you have any questions about your local market or your current investment, and subscribe so you get this analysis every week as the data rolls in. Now, if you're serious about building wealth through property but aren't sure where to start, whether you're a first home buyer wrestling to help to buy or an investor looking to diversify into different markets, Investor has built an entire system to help you. We've guided thousands of Australians through exactly this process, finding the right property, structuring the deal, and building a portfolio that actually works. Book a call with our team to discuss your situation. We'll walk you through where the opportunities are for your circumstances, how to navigate the current rate environment, and exactly what moves make sense for 2026. The link is in the description. Let's build your property future together. Thank you for watching.